Welcome everyone to today's Intelligent Property Investor Masterclass. The thing that's on the hot topic of everybody's lips at the moment seems to be interest rates. So I want to talk about that. I want to talk about where we sit at the moment, what's likely to happen into the future, and why the RBA is actually shrugging off some more rate hikes now. That's not quite what it seems, but I'll get into that as we get into the presentation today. I also want to talk about business confidence, because business confidence has been very optimistic, particularly in the last 12 months, and it continues to be so, with sales at a record boom at the moment, and that business confidence is flowing through to the bottom line. So if companies could only find the workers they need, that's the problem at the moment, because the hiring boom is affecting all industries. You know, it used to be just the agricultural industries because we didn't have the backpackers coming in. Well, I'm afraid it's all industries, and it's very, very hard to get a labour force at the moment. So I want to talk about the influences there and what that means, ultimately flowing through right through to wage increase and property pricing. How the much reported exodus from the regions might have never actually happened. That's a bit of an interesting topic, where we're looking at regional areas and property prices. Obviously, we've seen great increases in property prices in regional areas, but has there been that exodus? Has there been a big flow of people from city areas to country areas? Well, I've got some stats to show you on that one. I'm also going to be looking at the property market and why it's still standing strong, and why vendors aren't lowering their asking prices. So we've seen a little bit of a weakening in the market. We've seen prices start to soften a little bit, but we need to look at the longer term effects of that. Obviously, we're going through a flux period. Every time you have an election, everybody sits on their hands and does nothing for a period of time, and that'll flow through for a number of months after the election as well. So I want to talk about how the property market will respond once we get back to a status quo. I can put in inverted commas, normal. I don't think we've had a normal since pre-COVID. Let's have a look at this chart here. So let's talk about the interest rates for starters. The interest rate rises that we've had so far have been the first interest rate rises we have had for 11 years. Incredible that it's been that long since we've had an interest rate hike. But business confidence, retail sales, and job ads rose higher, highlighting the underlying strength in the economy. Now, that's what you can see there with the pricing model that I'm showing you there for different levels of interest rate hikes. Now, when we talk about the bond market, now the bond market is actually pricing in a significant increase. In fact, potentially the base rate up to 2.5%. Now, I don't think that's going to happen personally, because even the banks are saying that no, they're pricing in interest rate hikes of the base rate up to somewhere between 1% to 1.5%. Now, we're currently sitting at 3.5%. Sorry, not 3.5, 1.35%, sorry, 0.35%. So it's understandable if it went to 1 or 1.5. For it to get to 2.5, we would have to have a massive jump in interest rates in the next 7 months, which I personally cannot see happening. If you look at this chart here, and this really comes back to that business confidence again, and it looks at how, business confidence goes up and down, and you saw there, coming out of COVID and things like that, we zoomed up again. We came down when COVID was announced. We had a few lockdowns, and business confidence goes up and down. And it really, a lot of these things, the surveys that they do, it really depends on where they do them and who they're talking to at the time. But it does show you that right across the board, with the exception of a little bit in South Australia and a little bit in Tasmania, All the rest are showing really positive business confidence, which means that their underlying profits are actually quite good. And obviously, when businesses are making money, that it flows through to property in the end. It takes a long way to get there, but ultimately there's capitalization, there's more jobs, there's investment, and ultimately it ends up in the property market. This just shows you the same thing of the top industries. So which industries are more confident than others? And you can see there that, accommodation and food industries have taken a big step up because everything's opened up again. We're seeing wholesale up, agricultural up, property and business services are up, administration and support services are up, and across the board in Australia, a lot of the, we're confident. We're above the 100% mark, which means that we are in positive territory from a business confidence perspective. The ones that are a little bit on the downside are industries like construction, which mainly that is born from increased material costs and the uncertainty, I suppose, in a lot of construction now, because a lot of the middle size particularly, but also some of the big boys and even some of the little ones for that matter, have contracted onto properties that they are committed to building, but their quotes and their pricing, their contracts are all on old material cost values. So we will see some builders go broke. In fact, it's already started. We've started to see some of the middle-sized ones start to fall over first. I personally expect there to be more, because I've even known of some of the middle-sized housing builders that are buying back their contracts for $10,000 and $20,000. So if you'd signed a contract with the first homeowners boost and the builders boost and all of those things, which were based on pricing that isn't there today, and much lower pricing for materials and labour and the whole, right across the board, they simply can't build them for those costs anymore. So they're going to make a loss. It is cheaper for them to buy back their contracts at $10,000 to $20,000 than it is to actually build the house and make a loss. So how many times can you afford to do that? Well, it really depends on the size of the builder. So if anyone's going into construction at the moment, you really need to be doing some serious due diligence on your builder and the strength of your builder. Some of the other industries you can see there are retail, still a bit soft. Mining is interesting, is a little bit soft. I wouldn't have expected that. Maybe it's the coal industry rather than the iron ore. And recreation and personal and electrical, gas and water are on the soft side. So if we move to this chart here, now you can see here that retail sales are up. And if you look at the blue line, you can start to see that we are well and truly above the trend line. We were doing very well prior to COVID, then we had the massive drop in COVID, and we've gone up and down with the lockdowns basically since then. But you can see there that we are tracking way above the trend line. So sales could actually come down quite significantly without it actually affecting the overall trend that we've seen right back through the 2000s. This is the issue. We don't have enough staff. If you look at the national job ads are up nearly 3% there, but the national job ads over the last 12 months, for the last month they were up 3%, but over the last 12 months, the job ads have increased by 22.5%. National job ads are up, if you go back to 2019, so pre-COVID, are up 60%. My God, 60%. Now, I think the 60% is actually more telling than the 22%, because 22% is coming off a pretty low base. You've got to remember 12 months ago, we were still kind of struggling to get out of things. But if you go back to 2019, pre-COVID, 60% increase in job ads is very, very significant, which really highlights the need for a bigger labour force. And what's actually happening is that wages are going up. However, a lot of the wages aren't going up, per se. You know, the strikes that are going on with the public servants and the teachers and the nurses and whatever else. You know, all those bargaining negotiations are people staying in their jobs and negotiating a higher wage. But the biggest impact is actually coming from people changing jobs. So this is more from the private sector, where people will quit their job and go to another job in order to get a higher wage. So that's actually giving the wages a wages creep. So that's something to to understand, I suppose, about that labour market. And if you look at, I think I was reading the figures the other day, there was about 37% of the workforce today in this survey that was done. And as I said, you can, some surveys are a little bit of a grain of salt, but 37% were considering moving jobs for better pay. So a lot of it's coming up that way. And look, we need to. Wages have been down for too long. They haven't been keeping up with inflation. So I would expect throughout 2020 and probably into 2022, we're going to see some significant wage increases. Now, it's going to take some time for that to actually flow through to the property market in increasing costs. We've had a massive material cost increase. And what we're actually seeing at the moment, we're in this kind of a flux period where the costs have gone up, but the end sale price of newly completed houses hasn't hit the market yet at the higher pricing. So we're sort of in this bit of flux period, but that will happen, and it will happen over the next 6 months. So you're going to see newly constructed properties that are then going back on the market are being increased in value, increased in sale price, because of the absorption of all of the increase in material costs. And that hasn't come through yet, but it will. It absolutely will in the next 6 months or so. If we just go back to the slides, we can see here, this just reinforces what I said, basically, that Australian job advertising is up. Where the next slide shows us the job vacancies versus the advertisements. So job ads are up there in the green line, and the advertisements are there's lots of advertisements that are increasing, but they're not fulfilling the actual job vacancies that we have. So let's move off jobs and what that actually means. And let's have a look at this regional exodus. Did it even happen? Look, when we start to analyse the data actually suggests that the regional migration boom was actually about people moving to commutable cities. So places like the Gold Coast, places like Geelong, Newcastle, Sunshine Coast, rather than actually going bush. So people expecting true regional markets to keep on booming, well, I'm afraid you could well be disappointed, because even though some of the young kids that would normally move away from the regional areas have actually stayed in the regional areas, and that's a good thing, but all of this regional boom that we speak about, it's really been the fringe areas, like, as I say, Sunshine Coast, Gold Coast, Geelong, Newcastle, Wollongong, where public transport is actually better, or they can do 2 days in the office, 3 days at home, or vice versa. So it's not a real let's all go and live in Dubbo and Tamworth and wherever else you want to pick, Toowoomba. It's really about just the commutable areas, and more people are travelling. Now, how long that lasts, whether they get sick of the roadkill going backwards and forwards between their satellite suburb and the city, or whether the roads get upgraded, or whether we actually see some more better public transport and things like that. And that is happening. And if that happens, the move will be permanent, because people will prefer to live in the satellite areas than being at the higher pricing in the major capital cities. This chart actually shows us the population flow from the capital cities to the regional areas. And you can see there, yes, there was an initial push when we had all the lockdowns, but really it's starting to settle down now. And the proportion of profit-making sales by rolling quarter, you can see there that we're running in the regional areas very nicely. Really, the values of property pricing in regional areas jumped in line with what happened in the city areas. And these, you can see there that loss-making sales are well and truly down for both capitals and the regional areas. So across the board, the total net migration, yes, there's been a bit of exodus out of Sydney and Melbourne, and that's to be expected. Places like Hobart, pretty much nothing there really. Darwin, nothing. But places like Perth has had an increase, and Adelaide is sitting at net neutral. But have a look at Brisbane. Massive increase there for Brisbane. And then you have a look at the regional areas, and you can see there Queensland, 16,000 up for the regional areas. But when you actually have a look at it, it's probably Sydney. It's probably the Gold Coast and Sunshine Coast rather than where Hervey Bay or Bundaberg or any of the others. Yes, they've had some increase, but nowhere near what the figures are actually showing. So the net migration to the regions, you can see there, 2021 was a big move to the regions, if you count as the satellite cities as being regions. And the annual population growth there, you can see there 20-year average is about that 322,000 people a year. This is the thing that's lacking, because we haven't had migration happen yet. So once we open up to international migration, what we're going to see is the floodgates open. And if our average over the last 20 odd years has been 300 odd thousand people a year, we are going to get at least that, if not more. Now, regardless of who's in power and what their election policies actually are, I can tell you migration will be opened up towards the end of this year, middle to end of this year. And as soon as that happens, we are going to have a massive amount of pressure on pricing, particularly in places like Sydney and Melbourne. Most of the movement at the moment has been internal, and there's been a big movement to Queensland. But once we open up the floodgates, well, Sydney and Melbourne are going to really get a massive increase. And you can see there, we went from tracking in 2019 at nearly 400,000 new people to in 2021, we went to zero. In fact, we went -0. So we're actually losing people from Australia rather than opening up those floodgates. So that's going to make a big impact on the property market when that happens. Now, I can't tell you when that's going to happen. It's a political policy change that has to happen. But I can tell you, in order to pay for COVID, whichever government is in power, they are going to open up the international borders. So let's talk about the property market and how it's actually holding ground. Sydney and Melbourne are a little bit weaker. The days on the market for vendor discounting have barely changed, though. So if you have a look at these figures here, I'll just put it on the screen for you, and you have a look at how the change in dwelling values for the 3 months, all of them are up. You've got a little tiny little bit of a decrease or a softening in Sydney and Melbourne. So this is as at the end of April. And this is not what the mainstream media is telling you, but that's the data. That's actually what the data is showing for the 3 months to the 22nd, I think it is, of April that this chart goes to. You can see there that the regionals are up across all states, and all capital cities are up with the exception of Melbourne and Sydney. But Melbourne's only down 0.1 and Sydney's only down 0.5. So it's not a massive crash. But I do expect things to weaken slightly, a little bit more, before they open up once we start to get policy changes and we get over the election hump and all of those other things. This just shows you how this is the rolling 12 months, and they've come off the big highs, but we were very, very high 12 months ago too. This shows you the change in dwelling values over 12 months. Now, this is a little bit, I won't say optimistic, but it's showing a very positive outlook, because 2021 was so huge. The increases that we saw in 2021 were unprecedented. We had, in most areas a 20% increase, and in some areas a 30% increase. So that's like, once in a generational massive hike in property pricing. So, and that's what I was telling you all last year. It's about a land grab, as much property as you can get into, because that's what happened in the property market. We're going to still have growth, but it's not going to be to the same level of percentage increase as we've seen in 2021. I mean, God, it couldn't be, could it? Let's have a look at it. So this just shows you that annual change again. And we see here, the rolling quarters across across 4 of the capital cities there, being Sydney, Melbourne, Brisbane and Adelaide. And even though the markets have weakened a little bit even in Brisbane and Adelaide, they're still really positive. It's only Sydney and Melbourne that are sitting at 0.1 and 0.5 down. Even all the other capital cities, you look at Perth, you look at Hobart, Darwin, ACT, they're all up. They're all up for the quarter. And 2.7, 2.4, 2.2, 1.2, you multiply that by 4 and you've got a very significant price increase if that's what's going to continue to be projected. This just shows you the capital cities and how how the property prices have gone, and you can see on the chart there, the lower 25% is the dark purple, or the medium-sized purple. The light purple is the medium 50%, and the highest 25% values are the dark ones. And this chart is actually very telling, because what it shows is that the biggest movement has been at the top end of town. So the biggest movement is there with very highly priced properties. This is a change in sales of volume. I always like to look at sales volume because it really gives an indication of what's actually happening, because it's one of the first indicators for change in a market is sales volume. When sales volume starts to drop off, we start to see pricing start to weaken. And similarly, when sales volume starts to increase, you'll see a market that will start to heat up. It's one of the precursors to what prices will actually do. As we move on, we have a look at here. This is the monthly sales for 6 months moving average, and basically it's telling the same story that we've been talking about. The median days on the market, the only one that's really started to step out in days on the market is the Northern Territory, and that's to be expected. I mean, it really was a boom while we had, while it was in lockdown and people had to work in Northern Territory, so they rented up there and bought up there and all of those things. So there was a big boom at that point, but it wasn't going to last, and that's what I've been telling you as well. If we go back to the chart, you can see South Australia's days are starting to creep out a little bit. Darwin, obviously, regional Northern Territory, regional South Australia, Adelaide, tiny bit you can see there. But most of the days on the market are really tight. I mean, if you've got days on the market of 30, 37%, 16%, 19% for Brisbane, 28%, that's really low. You think about when you sell a property, how quickly do you want it to sell? Well, obviously you want to sell it in a week, but the reality is we're very used to properties sitting on the market for 1 month, 2 months, sometimes 3 months before they actually sell. So this is nothing to, this is still showing a really, really strong market. Median days on the market, that just shows you in another format how it looks, and how the days on the market came down substantially in 2021, which is what I said before, hot market, therefore the days on the market come down, and they've just started to increase, but only slightly, and has started really to level off more than anything else. This is a chart of discounting. So this is when you put the property on the market, how much the vendor ends up dropping the price before it actually sells. And again, this isn't much. We're talking about 2.5%, 3%, 4% is the most, which is regional WA, and that's to be expected. Darwin, again, to be expected. Hobart, interestingly, is showing a 4% there, but most of the rest are in 2% and 3%, which is well in order with what you'd expect for a pretty buoyant market bubbling along doing its thing. That, again, it's the same chart, but I'm just showing it to you in a line chart rather than a bar chart. So it's interesting times, and when you start to have a look at the bigger picture of what's happening, we're in a flux period. That's where we are. We're in a flux period, which is expected because of elections and because of, interest rates, uncertainty and things like that. But as I said, we've got a really strong underlying economy. We've got more demand than we have supply, and that alone should tell you that there is a lot of strength in the property market. We've got good wages growth. It's happening slowly. Inflation's a little bit high, but a lot of that is imported inflation because it's from the fuel pricing going up, and the war in Ukraine, and then China doing its business, and Middle East having a bit of a fluffle, and all of those sorts of things. So it's a lot of it's imported. Freight is the biggest thing because all that fuel flows through to freight, and all of our imported goods are now gone up. In fact, if you look at the Shanghai Freight Index, it has trebled since pre-COVID, trebled. So it's 3 times what it costs to get a shipment of whatevers from China to Australia, 3 times. So that's what's pushing up pricing. A lot of it is imported, particularly with fuel. I can't say what Putin's going to do and what the war's going to do, and NATO and all of that sort of rubbish, but while ever there is that uncertainty, you will have a flux period. But the economy will settle down. The economy's going to tick along. We are very, very strong, particularly compared to a lot of the other Western countries. We've got a really strong sound base, and we will open the doors to immigration. All of those things factor into price increases over the next few years. So you've got to get on your bike. You can't be sitting on the sidelines being a scaredy cat. Now is not the time to do that. So my thought for the week: it always seems impossible until it's done. And the second quote I've got here for you is, big journeys begin with small steps. So start your big journey right now. If you've been sitting on the sidelines, you've got to get off the sidelines. It is time to take action. You need to be taking action in a smart way, though. Don't just go and buy a lot of the stuff that is being touted at the moment, off the plan stuff, things that are, not even built yet. Things where they're offering rental guarantees. That's all the rubbish in the market. You've got to learn how to do a deal where you make money in the market regardless of what the market actually does. So that is why I'd like you to take up one of my 60-minute real estate breakthrough sessions with one of my advisors. Now, they're standing by. All you got to do is click through or go to iloverealestate.tv/questions/ and all you need to do then is click on one of the times, put it in your diary. Don't miss the time frame. And my advisors will be there to assist and talk to you about how you can actually move forward in the right manner, and how you can kick some goals. 2022 is about kicking goals, and it's time to start. We're nearly halfway through, so it's you don't want to be dilly-dallying on the sidelines anymore. So click through or go to iloverealestate.tv/questions and have an appointment with one of my advisors. They're about 60 minutes long, and they'll help you with how you can start to move forward. Come ready with your goals. Know what your goals are. Know what you want to achieve over the next few years, because the more prepared you are, the more we can actually help you in one of those sessions, and they're free. So that's it for me, guys. Thank you very much for listening this week, and I'll be back again to talk to you real soon. So bye for now.